What's up again, everyone? This is Eric, and this is my opening trade alert for Twitter. You're going to notice pretty quickly here that this kind of goes against the grain of what my normal trades have been in the past. It basically boils down to that I just sold a much more aggressive put than I normally would. However, one major thing to keep in mind here is I do not mind if ultimately I have to get assigned these shares. And so Twitter is trading around 48 bucks right now, I think, 47. So that means I would need to use $4,700 to buy 100 shares of Twitter if this goes against me, right? So if you're not comfortable with that, do not take an aggressive strike like this. So anyways, I'll get into that here in a second. The overall gist is here, I sold the 47 put in the March 19th expiration cycle, and I collected a $4.50 credit, which is much higher than usually I'm shooting for like $1.50 to $2. I've done Twitter in the past here, and I think it's been more like $1.50 I'm going for. Let's check out the trade tab here, and you'll see what I'm talking about. Another thing you probably noticed right off the bat is there's technically earnings in the way here. So this is kind of an earnings play that I'm rolling the dice on technically. And so earnings are in about 2 weeks on February 9th. You can see that I opened down here. That white dot means I have a position in the March 19th expiration cycle, which is 53 days. And that's normal, except for the earnings I usually avoid. Well, this time I'm actually using the earnings as a run-up to hopefully get some money out of it, right? Which is definitely a gamble. Like if you decide to do this, just be aware this is a gamble. Earnings can go either way. You can have positive earnings and the stock tanks, or you can have negative earnings and the stock skyrockets. It's how the news comes about, right? It's how it's framed. And you just never know how all the sheep investors are gonna react to it. And they might buy a bunch of it, they might sell a bunch of it, right? All I'd say, this is just technically a much more risky position to get into because of the earnings are in the way. And you'll see that I took a much more aggressive strike. So anyways, you got the earnings on February 9th. I usually go for the 30 to 60 day window, which this fits that at 53. But again, the earnings are in the way, which I normally avoid. So I go here to 53 days. And typically in the past, I'm usually out here around, the 15 delta, this column here. And I would be buying, like this one around $1.50, maybe even this one, $1.72, give or take, because that gives me a 74% pop right there at the 40 strike. If I go out to the 39, it's 77, but I'm still collecting $1.48, $1.50, give or take. And that's great. Like normally that's what I would recommend. But as you can see, I've decided to kind of roll the dice here, play a much more aggressive strike. And I went for the 47 put right here. I sold that. And as you can see, that's a much more aggressive delta at the 42 currently. When I opened this earlier today, I think this was actually at the 48 delta. And right now it's collecting 445 is the mid. I actually got 450, which is the high side here. So I'll bump it there. So I'm technically up like $5 on this trade already. However, it's just one day. I mean, I'm not planning on today. I'm planning on this in a week or two, right? So anyways, being that aggressive with the strike puts me at a 61% pop, which is pretty low compared to my past positions. But again, if I ultimately have to take assignment on these shares, where I have to buy 100 shares, I will go with that at 47, which would be $4,700, right? So if you're not comfortable with that, do not sell an aggressive put like this. You need to go much farther out, way up here like I was talking about, right? And that's normally what I would do. Anyways, 61% pop, 79% P50. My max profit, if I hold this all the way to expiration, would be $450. My max loss would, if I get assigned shares and then this goes to zero, I'd lose $4,000. And then the buying power effect here is pretty low. Even at this super aggressive strike, this is only requiring $870 in buying power. And that's why I like to trade Twitter on a regular basis, is because the buying power is lower. So your return on capital is higher. Because let's see here, if I would go out to my normal strike here, somewhere in here, look at that, the buying power drops to 400. And that's awesome. You're collecting 172 divided by 400. You're collecting 43% of the buying power. So then if you take a 50% profit of that, divide that by 2, you would get a 21% return on capital if you were to sell this more conservative strike out here, right? So even for me though, here at the 47, let's bump this up again to 450. I'm collecting 450 or $450, and the buying power is 870. You know, that's 51%, almost 52% would be the max profit. And then if I divide that by 2, you know, I can get 25.8% as a return on capital. And that's amazing. 25%. If you watch my other past videos, I have a lot that are around 10 or 12%. That's kind of my average. And then there's several that I'm at like 5% or even less. I think the lowest I've had before is like a 2 or 3%, collecting 50% of my max profit. Those are much higher dollar tickers like Nvidia and stuff like that. So that's why the return on capital is much lower. Anyways, 25% return on capital is awesome. I don't care how you slice that. That's great. All right, usually I would say you could turn this into a vertical spread here, which you could. I wouldn't really recommend that here, being so aggressive. You know, you could go out here, do a 5-point wide spread at 42 and buy that one as protection. That collects you $2.10 right now and lowers the pop to 53%, and the P50 is only 66. However, that gives you a max profit of 210 because you sell it for 210. Your max loss is only 290, and your buying power effect is just 290, and these are locked in. I guess the max loss is technically locked in for selling puts too, but it's much greater, right? And then certainly the buying power effect is even less. My buying power was, what was that, like 870 or something? Now this is only 290. So that's a pretty big drop. That's less than half of my requirement on the naked put. So if I went with this, I would be getting 210 divided by 290. That's really high. It's 72.4%. And then if you go for 50% of that, would be 36% return on capital instead of 25 like the naked put. However, you're getting less dollar amount, right? It's 210 versus, what was it, 450? So yeah, in general, I mean, I personally obviously am not doing the vertical spread there. For me, it just makes sense to do the put. I'm comfortable with assignment and I'm comfortable with the whole setup. All right, and then one last thing I want to touch on here is the IV rank, which is 54.6. That's pretty stinking high right now. You can see over here a lot of this stuff's like 18, 19, you know. Let's get this big list here. These are all my options. You know, Twitter is at 54.6%. That's like the 5th highest one on my list, where the average is probably more like, you know, down here, 27, 20, probably 20 is about the average right about now. And so part of this IV rank is we're going to take a look here at the Tastyworks chart. And the IV rank is down here. This is just the stock price, right? This is the IVR, or the IV rank from Tastyworks. And as you can see here, just a couple of weeks ago, the IV was way down here, you know, around 30 or so, which is still pretty high in general. But then up here, you had this sell-off, right? And so usually these bigger sell-offs raise the IV rank, right? And that's exactly what happened here. As the stock price went down, the IV went up. And so you went from 30, give or take, all the way up here. It peaked just below 60. And now right now it's settled in around 55. And the higher the IV rank, the better when you're selling options, because you collect more premium for the same strike simply based on the higher IV rank. And so that's what I did here. And that's kind of what sparked my interest. And then also after this big sell-off, even though earnings are in the way, again, you know, this big sell-off seems to be recovering here. And there just seems to be good support here, right? All right, I think that covers everything here in Tastyworks. Let's go look at the chart real quick on TradingView. So here on TradingView, you can see I opened the trade today here on the 25th of January. I sold the 47 put, which is this line, for $4.50. When I opened this position, the stock price was also around 47. I actually think it was more like 47.50, so somewhere up in here. So apparently I bought it kind of near the low of the day, which, whatever, that was lucky. I didn't plan that. And then since then, it's moved up like 30 cents, and it looks like post-market there, it says $47.84. So it's gone up about 30 cents since I opened this position, which, hey, whatever, that's great. It doesn't really matter. It's one day. Again, Twitter is coming down from this big sell-off here, right? And you can see this purple line here is an Elliott wave, and that's another reason I got into this, even though earnings are in the way. So if you zoom out here on the Elliott wave, it started way back here at the March low of the COVID crash. You had 1, 2, 3. This is the 4 wave, which is a correction wave. And you have the final 5th wave up here that usually goes beyond the 3rd. And even if it doesn't go beyond the 3rd, it usually gets really close to it. So the Elliott wave I was looking at here, and then also you can see this channel. It's been in that channel basically since the COVID crash, right? Then also the MACD here on the daily chart has not quite crossed positive. It's in the negative territory and it's weakening, which is good, which means the price is probably recovering. And then the RSI recently bottomed out here and is starting to move positive again. With that being said, I'm probably going to be using the 4-hour chart on this one. So right now I'm on the day, 1 day. So if I go to 4 hours, so here's the same thing in the 4-hour chart. And on the 4-hour chart, how I usually trade anything, whatever time frame it is, frankly. And I don't know why, but a lot of times doing this, my normal system, I don't look at this as often. I guess because I sell a lot of strangles, which I think I'm frankly getting away from, and just might be starting to stick to naked puts here more often. Anyways, so when I swing trade stocks, like if I'm actually buying a stock, what seems to work really well is that I swing trade on the 4-hour chart, which usually ends up being anywhere from a couple days to a couple weeks long of a trade. I use the MACD, and when it crosses in a positive direction below the 0 line, that's my buy signal. And so it did that right here just a couple of days ago. So I use the MACD for the buy signal here, and then I wait until the RSI, you can see the RSI bottomed out before the MACD, right? But just because the RSI is oversold doesn't mean that's a good time to buy. Because look, this initially became oversold here, and you could have bought way up here, but then it's still sold off to way down here. So in my opinion, the RSI, especially alone, is not a good system to use for when to enter the trade. However, when I combine it with the MACD, I use the RSI to exit the trade. So I enter here when the MACD is in negative territory and it crosses upward momentum, turns green here, right? And then I sell when eventually the RSI comes up here. Now, whether or not I do this for this trade, I'm not sure if I'm going to follow that system. But in general, that's how I trade swing trades, like trading stocks, right? So as a past example, you can see here that would work out perfect. There was earnings here. There was a massive sell-off. It was near the top of that channel anyways. Came way down here. Sure enough, the RSI got oversold first. This time it actually works out that the RSI kind of marked the bottom. I mean, right there is the bottom. It technically got oversold right there. Anyways, using my little system, if I would have been interested in this trade, I would have waited for the MACD to cross positive in the negative territory. So that's what it did here. It has positive momentum now, and it's below the 0 line. So then all I would have done is I would have waited here on the RSI. So I would have entered, let's say, right around 42.50, give or take, depending on when I got in there. And then from there, I'd be just watching the RSI. I would watch the RSI until it became overbought. So technically it gets overbought right there. So even if you're being conservative, and I sold out, from 42.50 up here to 47. I mean, that's like $4.50, right? So if I do $4.50 divided by 42.50, that's a 10% return on capital there on that trade. And that's if I would have sold out right here on this day where it just barely ticks the overbought line on the RSI. So normally what I do is I wait for the second day or the second candle, right? So that's the first candle, that's the second. And since that one wasn't overbought, I probably would have waited. And if that was the case, I would have waited until about here on this day. Yeah. If I would have saw a day like this, I would definitely sell here. Hopefully I'd get near the top here somewhere, even if I got in the middle. Now I'm around $50, and I initially entered in at $42.50. So that's awesome. So there's a quick glimpse into how I swing trade stocks. I'm probably going to make a video on it because frankly there's so many quote unquote gurus on YouTube, and it makes me sick because they're all selling these courses, and in my opinion they're full of crap. The easiest way to swing trade stocks or to trade stocks in general is to do what I just showed you. buy when the MACD crosses positive here, and then sell when the RSI becomes overbought. You like almost can't lose. It's crazy. It's so simple. No, you're not going to catch the very bottom, and no, you're not going to catch the very top. I mean, look, if I would have sold out here, it went from $51 or $50 all the way up here to 56. And yeah, people will be like, oh, you missed out on all that. Okay, great. But how would I know that's the top? How would anyone know? I mean, look at the MACD. It's still going up here, even though the price is going sideways to down. RSI is still overbought, you know, all the way to here. And then finally you get this big red candle where it's not overbought. So yeah, I guess you could hang on to here to $53, give or take. But the problem is sometimes you have these huge moves up and then you have these huge moves down, right? I mean, you just can't gamble that. I'll be perfectly happy buying in at $42.50 down here and then selling out around $50 here. I mean, that's a $7.50 gain on a $42.50 stock. Like, what are you complaining about? You know, like some people are just never satisfied. I just don't get it, man. And that's why they lose all their money eventually trading on the stock market. They just get greedy or they get impatient or whatever. So anyways, on that scenario, if I would have made $7.50 divided by $42.50, that'd be a 17.6 return on capital. Swing trading like I swing trade. I mean, how can you complain about that? But inevitably someone will always say,
oh, you didn't get the top. Or look at how much top that blew off there. Look at how much bottom you missed out. You didn't get the very bottom.
Yeah, so what? I caught the middle like 70% of the move and got 17% return on capital. Anyways, that's a different topic for a different day, I suppose. However, I am basically implementing that system here, right? So even with earnings in the way, the MACD on the 4-hour here has crossed up and it's below the zero. RSI is rising. You know, that it matches up with the Elliott wave correction here. So this is in the 5th leg, which is the final wave up. So yeah, so in my opinion, this is all turning out to be a nice little setup. Time will tell. And again, I am perfectly fine if I get assigned these shares and I have to spend $4,700 to buy 100 shares. Otherwise, if you're not comfortable with that, I would say sell like the 44 put at a minimum. And I think what we were looking at earlier, like 42 or something down here, you could still collect $1.50 and you had like a 77% chance of pop. So that seems like even a better setup, you know, as far as probability of profit. And frankly, that's normally what I would do, but I'm just being a little more aggressive here, kind of playing the run up to earnings, hopefully. But we'll see. I mean, this is hitting the 4-hour 200 moving average right here. So this could just trickle sideways for a while, which doesn't really matter. As long as it stays above 47, I don't care. So we'll see. I think that covers everything. I'll obviously keep you posted on what happens here. Trade small, trade often, and I'll see you in the next video.